There's a document in Washington, D.C., dense, arcane, and virtually unread by the people it affects most, that contains, buried inside its thousands of pages, a set of instructions so precise, so deliberate, and so extraordinarily generous that if you follow them correctly, the United States government will effectively pay you to build wealth. Not help you, not partially assist you, pay you. The document is the Internal Revenue Code. The instructions are what the wealthy have been quietly following for a century while everyone else complained about taxes. And the reason almost nobody knows this is not because it's a secret. It's because reading the tax code is, by design, the most boring thing a human being can do with an afternoon. That is, until you understand what it actually says. Then it becomes the most financially important thing you've ever read. Let me start with the one idea that unlocks everything else, because if you grasp it fully, this conversation will change the way you see money for the rest of your life. The Internal Revenue Code is not designed to punish you. It is not, despite the impressions it creates at the dinner table and on social media, an instrument of oppression. It is, with a clarity that should embarrass those who have never bothered to look, a menu. A menu written by Congress, revised annually, and offered to every American citizen regardless of their birth, their zip code, or their family name. The menu rewards specific behaviors that Congress has decided are good for the country: business investment, housing, energy production, retirement savings, education, charitable giving. And it penalizes, through omission, the people who never bother to order from it. A W-2 employee who collects a paycheck and pays their taxes as instructed is not being punished. They are simply paying the listed price because they never asked to see the menu. The average W-2 worker in America pays somewhere between 25 and 37% of their income in combined federal, state, and payroll taxes. The average affluent American, the kind who owns businesses, holds real estate, and participates in the investment structures Congress has specifically incentivized, pays closer to 15%, and sometimes considerably less. The gap is not explained by armies of lawyers finding loopholes. It is explained by the fact that one group knows the rules, and the other group has been told, implicitly and persistently, that the rules are not for them. That is the central injustice here, and it is entirely self-correctable. So let us begin at the beginning, with the investment category that the tax code rewards most aggressively and most broadly: business ownership. The moment a person establishes a legitimate business, the entire economic architecture of their life changes. The laptop purchased for client work, the vehicle driven between appointments, the phone plan used for business calls, the subscription services that run the operation, the education costs that sharpen the professional edge. All of it moves from the category of after-tax personal spending into the category of pre-tax business deduction. This is not a minor distinction. Under Section 179 of the Internal Revenue Code, for the 2026 tax year, a business can immediately expense up to $2,560,000 in qualifying equipment and software in the same year it is placed in service. Not spread over years, not phased in incrementally, but taken as a full deduction the moment the equipment is operating. The IRS confirmed this limit officially for 2026, and it represents one of the most dramatic expansions of small business expensing in modern tax history, having risen significantly from the $1 million threshold that existed just a few years ago. Consider the math with genuine attention because it is extraordinary. A W-2 employee earning $100,000 pays taxes on $100,000. A business owner earning the same gross amount can legally deduct equipment purchases, vehicle expenses, home office costs, professional development, travel, software, and dozens of other legitimate business expenditures before the IRS calculates what is owed. The business owner's taxable income might be $60,000, might be $40,000. Depending on the structure, it might be lower still. Congress did not create this disparity by accident. Congress created it because they want more small businesses in America, more private investment, more capital deployed into productive enterprise. The tax code is the policy instrument through which that preference is expressed. The wealthy, who understand this, operate businesses. Everyone else operates as employees and wonders why their taxes seem so high. And the compounding effect here is what separates the comfortable from the genuinely wealthy. A business owner who aggressively reinvests in their operation, buying equipment, hiring, expanding, can legally run at a paper loss for years while building real equity, real cash flow, and real market position underneath the surface. The IRS, through Section 179 and its cousin bonus depreciation, which for 2026 has been restored to 100% under recent legislation, has essentially told business owners, "We will subsidize your growth if you choose to grow." Most people never receive that invitation because nobody told them it existed. Now let us turn to the second investment category, because this is where the architecture of generational wealth is actually constructed, and it has been constructed this way for the better part of a century by families whose names are now associated with philanthropy, real estate empires, and inherited prosperity. The investment is real estate. And the mechanism that makes it so powerful is so counterintuitive, so cleverly constructed, that it almost seems impossible once you understand it. It is called depreciation. The tax code assumes that physical structures deteriorate over time. For residential rental property, the assumed lifespan is 27.5 years. For commercial property, 39 years. The IRS therefore allows you to divide the value of the building by that assumed lifespan and deduct the resulting amount against your income every single year. A $500,000 rental property with a $400,000 building value gives you approximately $14,500 of depreciation deductions annually for nearly 3 decades. But here is what makes this a phantom of the most beautiful kind in the entire tax code. The property is not actually losing value. In most markets, it is gaining value. The owner is collecting rent, building equity, watching appreciation accumulate, and simultaneously receiving a tax deduction for a loss that is not actually occurring. Income that is being earned is being rendered, on paper and quite legally, as if it were not earned at all. The wealthy understand this arrangement instinctively because their attorneys and accountants explained it to them early. Most Americans have never heard the word depreciation used in this context. That asymmetry of knowledge is the engine of generational wealth inequality in this country, and it has nothing to do with privilege and everything to do with information. Stack on top of that something called a cost segregation study, an engineering analysis that identifies every component of your property with a shorter useful life than the building itself: carpeting, appliances, fixtures, parking surfaces, landscaping. And suddenly you can front-load enormous amounts of depreciation into the early years of ownership. A sophisticated investor with a $1 million rental property can, using cost segregation, legally claim somewhere between $150,000 and $250,000 of depreciation in the very first year. That is not a misprint. That is the tax code, written by Congress, operating exactly as intended. Then add the 1031 exchange. Section 1031 of the Internal Revenue Code, which says that if you sell one investment property and roll the proceeds into another within a specific window, you owe no capital gains tax on the sale. None. You can do this indefinitely, rolling gains from small properties into larger ones, building an empire of appreciating assets, and the capital gains tax bill never comes due. When you die, your heirs inherit the property at its fair market value on the date of death, the stepped-up basis, and all those accumulated decades of gain vanish from the tax ledger entirely. The government has written the rules to allow the construction and transfer of real estate wealth across generations without the capital gains tax ever being paid. It is not a loophole. It is a deliberate policy choice, documented in plain language inside the code. Most people just never read the code. And I need you to stay with me here because I have not yet shown you the part that the wealthy are most determined to keep quiet. What I'm about to walk you through in the next section is the investment category that sophisticated family offices and private capital firms use to generate tax advantages so aggressive they almost sound invented. This channel exists to give you that information, and if this is the first time you've heard someone explain it this clearly, do yourself one favor right now. Hit subscribe, because we go this deep on every single topic, every single week, and you cannot afford to miss what comes next. There is a reason that the wealthiest families in America have been quietly, consistently, and with no particular fanfare investing in American energy for the better part of a century. It is not primarily because they love oil. It is because the federal government has created, inside the tax code, a set of energy investment incentives so aggressive that they constitute, for those who qualify, something approaching a partial reimbursement of the investment itself in the first year. This is not hyperbole. This is the arithmetic of intangible drilling costs, and it is one of the most extraordinary provisions in the entire Internal Revenue Code. When you invest in oil and gas through what the code defines as a working interest, you can deduct between 65 and 80% of your total investment in the very first tax year through what are called intangible drilling costs. the labor, the drilling fluids, the site preparation, the engineering work that leaves no salvageable physical asset behind. Put $100,000 into the right energy project, and you can legally write off $80,000 against your income immediately. Not over several years. Not in the form of a credit against future liability. Immediately, in the year of investment, against active income including W-2 wages, which is a carve-out that almost no other investment class in the entire code provides. Congress created this provision specifically because they want private capital to fund American energy production. They made the terms extraordinary because they needed to make the invitation compelling. The wealthy accepted. If your preference runs to renewable energy rather than fossil fuels, the landscape is equally favorable. The solar investment tax credit, preserved and expanded by recent legislation, provides 30% of your installation cost as a direct credit against your federal tax bill. A credit, and this distinction matters profoundly, is not a deduction. A deduction reduces your taxable income. A credit reduces your tax bill itself, dollar for dollar. If you owe the IRS $20,000 in federal taxes and you install a solar system generating a $10,000 credit, your bill drops to $10,000. No calculation of marginal rates required. $10,000, gone from the tax bill, owned now by you, along with the solar system, which continues generating electricity and economic value for decades. Wind energy, geothermal systems, battery storage, and qualifying electric vehicles carry similar credits. The Inflation Reduction Act, whatever its political controversy, was in practical terms one of the largest energy investment tax credit packages in American history. It was not, however, marketed to ordinary people. It was designed for those who knew to look for it. Now we arrive at retirement accounts, and I want to be clear about something before we proceed. Almost everyone knows retirement accounts exist. The reason I am raising them here is not to review familiar terrain. It is to show you the specific version of these accounts that most people, including many financial professionals, have never properly explained or fully deployed. Begin with the standard 401k. For 2026, the IRS has set the employee contribution limit at $24,500, up from $23,500 in 2025. Workers between the ages of 60 and 63 are permitted a special enhanced catch-up contribution of $11,250 under Secure 2.0, bringing their potential total to $35,750. These are meaningful numbers, but they are not the numbers that matter most for business owners. If you own a business, even a modest side enterprise, a consulting practice, a freelance operation, any legitimate commercial activity, you are eligible to establish a solo 401k, and the contribution ceiling changes dramatically. For 2026, the combined employee and employer contribution limit for a solo 401k is $72,000, confirmed by the IRS and multiple tax authorities, including Fidelity. $72,000 of pre-tax income that never reaches the IRS's calculation. For someone in the 32% federal bracket, contributing the maximum to a solo 401k represents something in the neighborhood of $23,000 in immediate tax savings in a single year. Every year. For the entire duration of their career. Compounded over 30 years at reasonable investment returns, the difference between maximizing a solo 401k and relying on a standard employee plan is, conservatively, measured in hundreds of thousands of dollars. And then there is the health savings account, which I would argue is the single most underappreciated financial instrument in the United States tax code. For 2026, individuals enrolled in a high-deductible health plan can contribute up to $4,400, and those with family coverage can contribute up to $8,750. Those figures are confirmed by IRS Revenue Procedure 2025-19. Now, why does this matter so disproportionately? Because the HSA is the only account in the entire tax code that provides what is called a triple tax advantage. Contributions go in tax-free, money grows inside the account tax-free, and distributions for qualified medical expenses come out tax-free. No other account type in America offers all three simultaneously. A traditional 401k gives you tax-free contributions and tax-free growth, but you pay taxes on distributions. A Roth IRA gives you tax-free growth and tax-free distributions, but you contribute after-tax dollars. The HSA alone threads all three needles at once. But here is the piece that virtually no one uses. You are not required to reimburse yourself for medical expenses in the year you incur them. You can pay medical costs out of pocket, save every receipt, allow your HSA to compound for decades, and then reimburse yourself for those past expenses at any future date of your choosing, with no statute of limitations. The HSA can, for the sophisticated saver, function as an additional retirement account with superior tax treatment, a hidden reservoir of tax-free wealth accumulating quietly alongside conventional retirement savings. The wealthy who understand this begin funding HSAs early and leave them entirely untouched for years, allowing the triple tax advantage to compound across decades. Most Americans see the HSA as a convenience account for covering copays. That misunderstanding is expensive. Let us construct a real human being, not a billionaire, not an inherited fortune, a business owner, perhaps a consultant, a contractor, a professional with a modest enterprise, earning $250,000 per year. Without any tax planning, this person faces a combined federal, state, and self-employment tax burden that could consume somewhere between $80,000 and $90,000 annually. More than 1/3 of everything they earn, gone before a single personal financial decision is made. That is the default position. That is what happens when you ignore the menu. Now watch what happens when they order. They contribute the maximum allowed to a solo 401k, $72,000 for 2026, confirmed by the IRS, combining their employee deferral of $24,500 with employer profit-sharing contributions. They contribute the family maximum to an HSA, $8,750 for 2026. They acquire a $300,000 rental property with a $250,000 building value and claim approximately $9,000 in straight-line depreciation. They commission a cost segregation study that front-loads an additional $30,000 of depreciation in the acquisition year. They pay their 2 teenage children a combined $24,000 in documented wages for legitimate work performed in the business: website maintenance, bookkeeping, client communication, administrative tasks, shifting that income from their high bracket to the children's zero bracket. They invest $100,000 into a vetted oil and gas working interest and claim $80,000 in intangible drilling cost deductions against their active income. They deploy the Augusta rule, holding documented business planning sessions at their residence 14 times during the year and collecting $28,000 in tax-free rental income from their business. Add up what has happened to their taxable income. The solo 401k contribution removes $72,000. The HSA removes $8,750. The depreciation removes $39,000. The wages paid to children remove $24,000 from the owner's return. The energy investment removes $80,000. By the time this business owner's accountant completes the return, somewhere between $200,000 and $240,000 of their gross income has been either deducted, shifted, or excluded from their taxable income through mechanisms that are entirely legal, entirely documented, and entirely available to every American who chooses to engage with the code. Their effective tax rate has dropped from the mid-30s into the single digits. The money they save, between $50,000 and $70,000 in a single year, is reinvested, compounded, and begins generating the kind of returns that look, from the outside, like inherited advantage. Now run that forward 10 years. The rental properties have multiplied, each one acquired through 1031 exchanges that defer the capital gains from one property into the equity of the next, with the tax bill perpetually rolled forward and eventually eliminated through the stepped-up basis at death. The solo 401k has accumulated, tax-sheltered, at compound returns. The HSA has grown into what amounts to a private medical endowment, waiting to be deployed against decades of accumulated, documented medical expenses at a moment of the owner's choosing. The oil and gas investments have generated additional deductions in subsequent years. The children now have their own Roth IRAs, funded with the earned income from their legitimate business wages, and those accounts will compound tax-free across the entire arc of their financial lives. The business itself has grown, partly because its aggressive investment in equipment and operations was subsidized by the deductibility of those very investments. This is not a fantasy. This is the compound architecture of wealth as it is actually constructed by the families we most commonly associate with it. The mechanism is not mysterious. It is methodical. Every element is documented. Every strategy is confirmed by the IRS in plain published guidance. The only thing that separates the person who builds this architecture from the person who does not is the decision to read the instructions. Now, I want to address the most common objection because I hear it in every conversation about this subject. This sounds complicated, and I don't know where to start. That objection deserves a direct answer. You start with one strategy, not 10, not the entire architecture assembled simultaneously. You identify the single intervention most relevant to your current financial position, and you implement it with qualified professional guidance. For most people who have any kind of side income, that means establishing a business entity and beginning to capture the legitimate deductions that the code already offers them. For people who already own a business, it often means establishing the solo 401k they have been delaying. For property owners, it means consulting with a cost segregation specialist. For high earners with capital gains, it might mean exploring an opportunity zone fund. One strategy, implemented correctly, creates the foundation for the next. That is how the architecture is built, not all at once, but deliberately, sequentially, and with professional guidance at each stage. Consider also the broader civic dimension of what the tax code actually represents, because I think it is frequently misunderstood. When Congress writes a deduction for real estate depreciation, they are making a policy decision that private investment in housing stock is preferable to a world where the government owns and manages all housing. When they write an energy tax credit, they are making the determination that private capital is a more efficient allocator of energy investment than central planning. When they create the small business deductions, they are betting that decentralized entrepreneurship produces more economic dynamism than consolidated employment. The tax code, whatever its complexity and whatever its imperfections, is at its core an argument about how a free society should organize its productive capacity. The incentives are the argument made concrete. When you use them, you are not evading the system. You are participating in it exactly as its architects intended. The Research and Development Tax Credit extends this logic into innovation. If your business develops new products, tests new processes, builds custom software, or improves existing products, you may qualify for a federal R&D credit worth up to 20% of qualifying expenditures. A small software firm developing a proprietary application, a food manufacturer testing a new formulation, a fabrication shop designing custom components, all may qualify. Most small business owners have no idea this provision exists. Most general practice accountants are not positioned to claim it properly. The businesses that do claim it are, in effect, receiving a direct government subsidy for innovation that the Congress determined was worth subsidizing. The wealthy who own those businesses accept the subsidy without apology because it was offered. The backdoor Roth IRA and its larger sibling, the mega backdoor Roth, extend these advantages into high-income territory where conventional Roth contributions are prohibited by income phase-outs. The backdoor Roth contribute to a traditional IRA on an after-tax basis and immediately convert to a Roth has been confirmed as legal by the IRS in published guidance. The mega backdoor Roth, for plans that allow it, permits after-tax contributions of up to roughly $47,500 beyond the standard employee deferral, all of which can be converted to Roth status and grow tax-free forever. The combined solo 401k total for 2026, including these provisions for plans that support them, can reach $72,000 under 50, $80,000 for those 50 to 59, and $83,250 for those 60 to 63. These are not small numbers. They are the architecture of retirement security, available and unused by the overwhelming majority of eligible Americans. Historic rehabilitation tax credits offer a 20% credit against qualified rehabilitation expenditures on certified historic structures. A $1 million rehabilitation project generates $200,000 in direct tax credits. Combined with depreciation and cost segregation on the rehabilitated property, an investor in historic real estate can build a portfolio while the government subsidizes a meaningful fraction of the capital deployed. Low-income housing tax credits offer something even more direct. Credits worth up to 9% of qualifying investment annually for 10 years, effectively allowing the government to return 90% of the invested capital in tax relief over the decade, while the investor retains ownership of the property and its rental income. This is why the largest private investors in affordable housing are insurance companies and well-capitalized family offices. They understand the arithmetic. The arithmetic is available to anyone who bothers to learn it. Here, then, is what I want you to take from this conversation. The tax code is not your enemy. It is not a system designed to extract your earnings for redistribution. It is, imperfectly and incompletely but genuinely, a set of instructions for building wealth in America. Instructions that were written by elected representatives, published by the Treasury Department, interpreted by the courts, and made available to every citizen regardless of their starting position. The families you most associate with generational wealth did not build it primarily through harder work. They built it primarily through consistent, patient, professionally guided use of the code's incentive structure. They started businesses. They bought real estate. They invested in energy. They maximized retirement accounts. They deployed every legal provision available to them, year after year, without apology and without embarrassment. Because they understood that accepting the government's invitation to participate in the economy as Congress designed it is not a privilege, it is a choice. And it is a choice available to you. The gap between where you are and where you want to be is not primarily a gap in income. It is a gap in financial literacy. Specifically, literacy about the document that governs how wealth is built and transferred in this country. Close that gap. Find the professionals who know the code and who practice tax strategy rather than tax compliance. Implement one strategy, then another, then another. This is how it is done. This is how it has always been done. And now you know. What I want you to do right now, before you move on, is leave me a comment below with one word, the single tax strategy from this conversation that you had never heard before today. One word, one strategy. I want to see what this community knows and what it needs to learn next, because that is how we decide what we cover next week. The conversation we have in those comments is the most valuable thing this channel produces. Be part of it. And remember, this is for education and discussion only, not personal financial advice. I'm sharing a way to think through the history, the market, and the ownership questions so you can make your own decisions with your own money and your own risk in mind.